Mobia Medical, NASDAQ ticker MOBI, beat consensus on the top line, but completely missed on the bottom line for Q2 2026.
Yeah, missed it by quite a bit.
Right, so revenue came in at $13.51 million. That is a 102.4% year-over-year increase, beating the S&P global consensus of $12.30 million by nearly 10%.
Which sounds great on paper.
It does. But then earnings per share came in at a net loss of $21.0 million. So that translates to an EPS of negative $1.00. And that totally missed the Wall Street consensus of a negative 83-cent loss per share.
And what's wild is they actually initiated full year 2026 revenue guidance of $54.0 million to $56 million.
That's huge.
Yeah, it represents 69% to 75% growth, completely blowing past the roughly $53.5 million analyst consensus.
But the stock reaction tells a totally different story. MOBI closed the regular session down 1.18% to $12.58 on really light volume.
Right.
It stayed flat in after-hours trading immediately following the print, and then it just took an 8.51% hit the following trading day as the market digested that earnings mess.
It's proof.
Imagine doubling your revenue, crushing Wall Street's expectations, giving fantastic forward guidance, and your reward is your stock dropping 8.5%.
Yeah, welcome to MedTech.
Exactly.
Yeah.
If you're tracking the medical device sector, this earnings report is a masterclass in market mechanics. We're jumping right into a targeted breakdown of exactly why top-line hypergrowth for a post-IPO medtech company is, it's not always enough to satisfy the market.
No, not at all.
We have a classic divergence on our hands here. A massive revenue beat overshadowed by an even more massive surge in operating expenses.
Yeah, and looking under the hood of that $13.51 million revenue figure, it really reveals the defining tension of a commercial stage medical device company.
How so?
Well, that top-line growth is being driven almost entirely by the rapid adoption of their Vivystim paired VNS system.
The vagus nerve stimulation system.
Exactly. We're seeing this system being aggressively adopted across both comprehensive and primary stroke centers. And that's happening alongside an increased volume of IPG, or implantable pulse generator, unit sales. I mean, they moved approximately 367 Vivystim units in this quarter alone.
Which is exactly the narrative management wants to sell to Wall Street, right? Doubling revenue year over year. You want to show that hospitals are actually buying what you spent years and millions of dollars developing.
Yeah, absolutely.
But moving 367 units is carrying a massive, almost punishing price tag for the bottom line.
It really is. And what's fascinating here is the underlying margin and expense dynamics.
Okay.
Because the actual unit economics of the Vivystim system itself are incredibly strong. Their gross margins actually improved year over year, hitting 83.2%.
Wow, 83.2. That's fantastic.
It is. That yielded $11.2 million in pure gross profit. But the operating expenses to get those devices into hospitals, they skyrocketed 83% to $29.2 million.
Okay, let's unpack this. Because for a retail investor reading this earnings report, the math is just tough to swallow.
Yeah, the optics aren't great.
I mean, they're spending almost $30 million in operating expenses to make $13.5 million in revenue. You have a 102% revenue growth rate, but the net loss practically doubled year over year.
Wow.
From $10.5 million to $21 million.
Right.
Selling, general, and administrative expenses, SG&A, that hit $26.9 million alone. That's an 85% jump. R&D grew 61% to $2.3 million. I guess my question is, at what point does buying market share become, just setting cash on fire?
Well, the cash burn looks alarming in a vacuum, I'll give you that. But you have to look at the mechanics of selling a Class 3 medical device.
Okay, fair.
They are scaling up their commercial organization aggressively, and that requires highly specialized personnel. Selling a vagus nerve stimulator isn't like selling hospital beds or a generic surgical tool.
Yeah, it's a permanent implant.
Exactly. An implantable pulse generator is essentially a pacemaker for the brain. It's surgically placed in the chest, with leads connecting up into the neck to the vagus nerve.
And the therapy itself is highly complex, right? It's not just a device that runs passively in the background.
No, not at all.
It physically helps the brain rewire itself through neuroplasticity during physical therapy.
Yeah, so it requires deep, ongoing integration. A sales rep for Mobia isn't just dropping off a cardboard box at the hospital loading dock and saying good luck.
Right.
They have to be in the operating room to support the surgeon during the implantation. They have to coordinate with neurologists. They have to train the physical and occupational therapists on how to pair the device's electrical stimulation with the patient's specific rehab exercises.
So you're paying for a highly trained clinical and commercial team to literally embed themselves in these specialized stroke centers.
Exactly. That's why the $26.9 million SG&A line item makes a lot more sense when you understand the business model.
It's like laying fiber optic cables.
That's a great analogy.
It costs an absolute fortune to dig up the streets, lay the wire, and connect the houses. But once a hospital is plugged into the system, and the surgeons and therapists make the Vivistim procedure a routine part of their stroke protocol, the cost of selling that next unit drops significantly.
Yes. And if we connect this to the bigger picture, that high initial cash burn is the precise reason Mobia Medical went public in May.
Oh, for the IPO cash.
Exactly. They needed a massive war chest to fund the construction of that exact commercial engine we're talking about.
Let's pull up the balance sheet, because that IPO capital is essentially the only thing keeping the lights on right now.
Yeah, they ended the second quarter with $177.1 million in cash and cash equivalents. And that balance was massively bolstered by the $134.0 million in net proceeds from their May 2026 IPO.
Which is a huge cushion.
It is. By securing that capital, management effectively neutralized any immediate going concern risks. They bought themselves the runway to absorb these heavy quarterly losses while they build out the infrastructure.
And we're actually seeing that physical infrastructure materialize in the numbers, which is a good sign.
Right.
Active sales territories jumped 92% year over year.
Almost doubling.
Yeah, they're now operating an average of 35.5 territories. Management also signaled on the call that they plan to add 4 to 5 new territories quarterly throughout the second half of the year. So the cash is clearly being deployed to put specialized reps into key stroke centers.
And the strategy is executing exactly as designed. They are saturating key geographic markets where high-volume comprehensive stroke centers are located. They're prioritizing institutions that actually have the neurology and rehabilitation departments necessary to support the full paired therapy.
So what does this all mean? I mean, building out 35 active sales territories is a great operational metric.
Sure.
But let's look at the market mechanics here. The daily average trading volume for MOBI is under 200,000 shares.
It's really thin.
Super thin. Combine that low liquidity with an EPS miss, and institutional investors clearly seem to be sitting on their hands in this, like, wait-and-see posture.
Yeah, they're hesitant.
So what metric actually proves to those institutional buyers that this newly expanded sales team is achieving true operating leverage, rather than just adding really expensive headcount to the payroll?
The beacon in this earnings report, the one metric that proves the long-term viability of the business model, is that 83.2% gross margin.
That's the holy grail.
It is.
Yeah.
That is the fundamental indicator for institutional investors who are willing to look past the current quarter's cash burn. A margin that high proves two vital things. One, Mobia has absolute pricing power, and two, they have highly efficient manufacturing unit costs.
Okay.
So the bottleneck for this company isn't the product margin, it's simply market penetration.
Because the gross margin is so pristine, it means every incremental unit sold in a mature territory is going to drop significant profit down to the bottom line.
Exactly.
It's the classic difference between trying to scale a low-margin hardware business where your costs scale linearly with your sales versus a high-margin medical device business where the profits just compound once your fixed costs are covered.
Right. And the current reality is that the gross profit of $11.2 million is completely eclipsed by the $26.9 million in SG&A.
Yeah, it's not even close yet.
But if management can maintain that 70% to 100% top-line growth rate over the next 2 to 3 years while holding that 83% gross margin steady, the revenue and expense lines on the chart will eventually cross.
The classic inflection point.
Yep. The territories will mature. The reps will be able to handle higher volumes of procedures without needing additional headcount, and the operating leverage will finally kick in.
But hitting 35 sales territories and achieving 83% margins doesn't mean anything if the hospitals can't get paid for the device.
Oh, reimbursement, the giant elephant in the room.
Right. A medical device company lives and dies by one thing, and that's insurance coverage. You can have the best clinical sales team in the world and a device that genuinely changes lives, but if payers aren't reimbursing the procedure, hospital purchasing committees are going to block the adoption.
Every single time.
Which brings us to the brutal structural reimbursement reality Mobia is facing right now.
And this is where the long-term clinical narrative clashes violently with the short-term financial reality of the stock market. Mobia holds FDA pre-market approval for the only clinically validated vagus nerve stimulation system dedicated specifically to chronic stroke recovery.
Here's where it gets really interesting. They just announced the publication of 2-year follow-up data from their VNS RHAB trial in the peer-reviewed journal Neurology.
That's a top-tier journal.
It is. And we were talking about durable, clinically meaningful improvements in upper limb motor function and activities of daily living for chronic ischemic stroke survivors.
Yeah, the data is incredible.
In the clinical world, meaningful improvement means a patient who couldn't use their arm for years is suddenly able to button a shirt, pick up a cup of coffee, or feed themselves. And 2 years post-implant, those patients are still seeing the benefits.
Right.
In the medtech world, establishing that kind of clinical moat is everything.
It really is, because the data proves they aren't just selling a novelty. They are establishing a new standard of care. And that deeply peer-reviewed clinical data is exactly what drives the regulatory economics.
The money side of things.
Exactly. Based on those outcomes, the Centers for Medicare and Medicaid Services, CMS, proposed to maintain the Vivystim procedure payment rate at approximately $45,000 for calendar year 2027.
$45,000 per procedure. That is a massive price tag for Medicare to absorb.
It is. The procedure remains assigned to the New Technology Ambulatory Payment Classification, or APC 1580.
Right, the APC code.
Yeah. The final rule for the hospital outpatient prospective payment system is due in November, but that $45,000 rate establishes a very solid, highly lucrative baseline floor for Medicare patients.
We should decode that for a second for anyone who hasn't dealt with medical billing.
Yeah.
Think of the New Technology APC 1580 classification as like a temporary VIP pass from Medicare.
I like that, a VIP pass.
Because normally, if a hospital decides to use a brand new, expensive piece of technology, the hospital has to eat the cost difference under standard bundled payments.
Which they hate doing.
Right. But a new technology add-on payment guarantees the hospital will get a set, higher amount, in this case, around $45,000. So they aren't destroying their own profit and loss statement just to try out an innovative therapy on a Medicare patient. It removes the financial friction for the hospital.
And this raises an important question, because while that CMS rate is a massive win that provides a pricing floor, Medicare is only one piece of the puzzle.
What about private insurance?
Exactly. The critical risk factor noted by management in the earnings call is the commercial payer landscape. Establishing broad universal coverage with private insurance companies, the Aetnas, the Cignas, the United Healthcares of the world is going to take years.
Because commercial payers don't just hand out $45,000 authorizations based on one journal article.
No, they do not.
They require mountains of real-world evidence, independent health economic studies, and years of peer-reviewed data before they agree to universally cover a new implantable device. I mean, they are incentivized to delay coverage as long as medically justifiable to save money.
And that multi-year timeline fundamentally limits near-term patient access. It does not matter if a chronic stroke survivor in their late 50s is the absolute perfect clinical candidate for the Vivystim system.
Right.
If their private commercial insurance refuses to authorize the $45,000 procedure, the hospital cannot perform the surgery. The sales rep loses the sale, the hospital loses the procedure volume, and the revenue growth stalls out.
And that specific dynamic explains the stock's sluggish after-hours reaction and the subsequent 8.5% drop the following day.
Exactly.
The daily market looks at the heavy $21 million cash burn, looks at the multi-year slog required to secure commercial payer coverage, and realizes that true profitability is a multi-year waiting game. And the daily market hates waiting.
Oh, they despise it.
They want operating leverage now, not in 2028.
But the divergence between daily retail sentiment and Wall Street analyst targets couldn't be starker right now. Let's look at the notes following this print. The stock was trading down around $11.50 to $12.50. Yet BTIG Research reaffirmed a buy rating with a $19 price target. Bank of America maintained a buy at $16. JP Morgan maintained an overweight rating at $17.
Wow, so they're all way above the current trading price.
Way above. The institutional analysts are looking at the clinical moat, the incredibly high 83% margins, the FDA approval, and the CMS pricing floor. The daily retail market is just staring at the $21 million net loss and dumping the stock.
Because the analysts understand the typical life cycle of a commercial stage medtech company. The $134 million IPO gave Mobia the runway they needed. The 2-year data in neurology widened the clinical moat so competitors can't easily catch up.
Right.
The CMS proposal solidified the pricing floor so hospitals feel safe buying the device. The pieces are all on the board, but assembling them into a genuinely profitable income statement takes years of grinding execution by that sales team.
Yeah. To bring it all back to the numbers we opened with, the top line beat of $13.51 million shows the sales force is successfully executing the territories they have already established.
Yes.
The bottom line miss of negative $1.10 per share shows exactly how expensive it is to maintain those territories while fighting for broader insurance coverage.
So you are looking at a stock hovering around the $11 to $12 range that sells a single clinically validated device with a $45,000 reimbursement tag attached to it.
Yeah.
And as Mobia does the grueling, unglamorous, multi-year work of knocking down those commercial payer hurdles and expanding their sales footprint to new stroke centers, the real question isn't just when they will organically reach profitability on their own.
No, the real question is whether a larger healthcare conglomerate will swoop in and acquire them long before they ever have to reach profitability.
Oh, the M&A angle.
Think about it. When you have a proven clinical moat and pristine 83% gross margins, you become an incredibly attractive target for a massive medical device giant. A conglomerate with an existing global sales force and established relationships with every major insurance payer could acquire Mobia, instantly strip out that massive SG&A overhead we've been talking about, and drop those 83% margins straight to their own bottom line.
It is the ultimate medtech exit strategy. Build the clinical moat, secure the regulatory approvals and initial reimbursement codes, prove the early commercial demand in key territories, and then let a giant take it from there.
Exactly.
Well, if you want to keep tracking whether Mobia can thread that needle and catch the rest of our daily no-fluff earnings coverage for retail investors, make sure you follow the deep dive.